Thank you, Lodi. All right. So, what do you guys want to talk about? How do you guys feel about your financial statements?
Pretty good on financial statements. Can we go over what the last test was over?
Okay, so that was chapter 11 and chapter 3.
Yeah.
So what part of it was struggling?
A lot of it, I was just confused with like treasury and common stock and all the rules that private is on.
Yeah, of course. So I'm going to put 3 categories here. We got common stock. We got preferred stock. We got treasury stock. Right off the cusp, who owns common stock usually? Stockholders. Who owns preferred stock?
Fine.
No, you're good. Thank you.
What was it?
Who owns preferred stock?
The country.
So, what is the difference between common stock and preferred stock?
I know one receives dividends.
Which one receives dividends?
Dividends.
So does that sound like a company bonus or a stockholder bonus? Mhm. Now, what about treasury stock? Who has that one? Company. So, common stock. How do we typically figure out how much our common stock is worth?
Multiplying it by the value.
How about preferred stock?
Would that be like a given amount or percentage?
So is that how much the stock is worth or the dividends worth?
How much the
So the percentage for preferred stock, that percent is specific to dividends. So to figure out your dividends, use shares times R times percent. To figure out the value of the stock itself, it's just shares times par. And same thing as common stock. Basically, whenever you're doing journal entries trying to figure out shares times par, shares times par. Now, what about treasury stock? How do we figure out how much treasury stock is worth? So what dictates how much treasury stock is worth later on? How do we usually get treasury stock?
It's like leftover.
Not leftover.
It's outstanding.
Not outstanding. It is issued though. And we know the company owns it. So how does a company own it? Yep. The trick question is repurchase. So there's never really a set par value for treasury stock. For treasury stock, it's always going to be exactly what you bought it for. So if we bought treasury stock $20 per share, we know that its par value is then set at $20 per share, and that is its par for as long as we have it. When we sell it all out, then we have a new par for when we buy it back. So what are the normal balances for these guys? A debit or a credit? Exactly. This is because technically common stock and preferred stock, they increase our shareholders' equity. But treasury stock itself decreases shareholders' equity. Second. And that's typically associated with the fact that we credit common stock, preferred stock, but we debit treasury stock, making this a contra equity. So some other good things to know about Chapter 11, especially for the test, is who has voting rights? How do you figure out the dividends for common stock?
Yeah.
Yeah. What about paid in capital of excess? What kind of account is that? How do we use that? Nope. It is just a credit, but where do we typically see it? Where do we use it? It attaches itself to everything here. It's a plug account. And can typically be debited or credited, depending on the situation, specifically with treasury. But I don't think you need to know too much about that. I think you just need to know, typically when we're selling these stocks, any of these stocks, we'll be using APIC or PIC. Blocker's class is APIC, Yeager's class is PIC, to basically figure out the difference. So let's say if we sold $1 par common stock for $20, you get that cash of $20. Common stock would be $1, while PIC would be that 19 excess. Does that make sense? Any questions over any of this so far? So what are to kind of continue on this, what kind of component is specifically our common stock and preferred stock in our APIC and PIC account? Because there's two components to stockholders' equity. Contributed capital. All of these are contributed capital. How is this generated, externally or internally? It will be generated externally. The reason why is because if you notice here, we're getting this from stockholders. not from the company itself. This is all from the stockholders that are buying the stock, who believe in us well enough to give us money. Or it's from the owners, which technically are a separate entity than a company, because a company is its own entity once you make it into a company. What's the other component to stockholders' equity? We have contributed capital. What's the other one? Retained earnings. Internal or external? This is our internal component. This is our blood, sweat, and tears of the company. Our revenue, expenses, and dividends. Good. So I'm going to make three little questions to make journal entries, just to practice journal entries for this chapter. And then we'll move on to another question. But does this help your understanding for like?
Yeah, that's like a nice visual to everything.
I tried.
No, it's
There's question one. Question two will have two parts. All right, I'll give you a couple minutes to kind of go through that. All right, let's start going through this. So first things first, we reissued 600 shares of common stock at par 4 and $30 per share. I should have swapped those $4 at par, but let me see. What's gonna be the journal entry looking like? Debit to cash for how much? We understand how she got that 18,000? 600 times 30. Shares times par. Wait, not par. Shares times cash. Not par. This value right here, consider it that's your cash amount. That's amount that each person paid for each share. So every time you gave them a share, they gave you $30. Now, what's the next part of this equation? How much? The 400. Do you understand how we got? She got to 2,400.
No, 600 times par.
600 times par. That's the one where it's shares times par. All right. Now, can we leave it at that? Or do we need a little bit more? Okay. For 15,600. Y'all understand how we got to 15,600? Perfect. This is why we call pick a plug account. And that would be our answer to figure out the journal entry. Now, if we said this was preferred stock, would anything change? What would change? So if this was preferred stock, would anything change about this journal entry? Nope. There's going to be, whenever you see preferred stock mentioned, you'll see a percentage. Remember, that percentage is only for dividends. It is not at all relevant towards when you're issuing stock. So we ignore it unless we say, hey, they're going to get paid dividends. How much dividends is preferred going to get? And that's when you start multiplying that percentage. So let's go down. We will purchase common stock at $20 per share. What's going to be our debit? What's going to be our credit?
Wait, why is it treasury? Oh, because you rebuy.
Yep. I throw in common stock because that's always going to trip up students, and that's something you'll see on the test. Repurchase, the moment you see repurchase, even if you see common stock, remember, it's treasury stock. If you look at a version of stockholders' equity, you're going to see common stock at the issued value. Issued value includes both treasury, and it also includes your outstanding, which is your normal common stock accounts. This is why we subtract out treasury stock when we're going through stockholders' equity. Open. So, how much are we debiting treasury stock for?
20,000.
20,000. Now, what else is happening here? Credit to cash. Same amount?
Yes.
Any questions here? Perfect. We reissued 500 shares for $25 per share. What's my journal entry here? Debit to cash for how much?
12,500.
All right. Credit to treasury stock? For how much? 10,000. Do y'all understand how she got to 10,000? Treasury stock par value, the moment you buy it. So if you look back over here, when we were talking about treasury stock, we said par equal to the number of dollars the share is bought at. So this is where this comes into play. We bought this treasury stock $20 per share, so it needs to stick at $20 per share no matter what. So when we're reselling it now, the treasury stock value doesn't change just because cash value changes. Instead, we have to stick to the number, to the amount we bought it at. That way we're able to drain the account appropriately because we don't want it to go into the negatives. So what's going to be the other account because this doesn't balance? Pick treasury stock. And that'd be your journal entry. So any questions on any of this? All right. So that's just a little run through chapter 11. What questions do y'all have? What chapter do you guys want a little visit to? Yeah.
Sorry. For the treasury stock, you did 30 times. What was it?
20 times.
Oh, I see.
Yeah. So right here we have 20 times 500 and 20 times 1000. I'll leave it up on the board while we're going through. So we're going through chapter 3 now. Any specific point of chapter 3, or are we just going through a little stroll through chapter 3? Just a little stroll. Nothing's wrong with a little stroll for chapter 3. All right. We're going in whatever direction y'all need. So we can't do like normal exam studies where I'm just bullet pointing through things. That would take a day of accounting group study. So instead it's just jumping through which ones you guys find the most important to work through.
Do you have the test? I like the copy of it.
No. I just have the exam reviews, and even if I did have the test, I would not show it off to anyone. So we're going to go through accrual versus cash. We'll start off with that. So first things first, does this deal with deferred or accrual yet? Or are we just at the very, very top of this hill? Because I know this gets people confused because we use accrual with accrual and deferral and accrual versus cash. With this right here, we're just talking about the basis of accounting. So within accrual basis and within cash basis, what are the differences?
Money for cash comes after.
So you're thinking of deferred and accrual. We're just talking about the basis of accounting. So accrual accounting and cash accounting. The revenue recognition principle. Basically, you recognize revenue when the service is performed. When do you recognize revenue for cash basis?
When you get cash.
All right. How about expenses? When is expenses recognized for accrual? So revenue is when you perform a service. What did you say? When it's incurred. Expenses are All right, what about with cash? When do we recognize expenses of cash? Yeah, when you pay it. All right. So this is where we start getting into like the nitty gritty of the accrual accounting system, because which one's GAAP approved and which one is not GAAP approved?
Accrual list, gotcha.
All right. So with that, now we're going to be talking about accrual and deferred. So I'm going to throw some scenarios up here. What I want you guys to do is write the journal entry, but also tell me if it's accrued, if it's deferred, and if it's an expense or if it's revenue. Now the question is, will you recognize cash at all with any of these? Nope. In adjusting entries, you will never recognize cash. Let me pull out some familiar. Tools trade. The day, by the way, is December 31st. So that's your reference with these dates to understand how much you accrue and such like that.
So what about December?
December 31st is a date, so that's going to be important for some of these that have dates. All right, I threw a lot at y'all. I'll give y'all about, hopefully you guys have already started. I'll give you guys about like 6 minutes to go through these. Remember, note if they're accrued, note if they're deferred, note if they're expense, note what if they're a revenue, and try to write the journal entry down for them. Some of them have some extra math, and this would be important to know how to figure out for your test.
You said do journal entry, yeah.
Journal entry, and just note if it's accrued or deferred, or revenue or expense. If you figure out if it's an expense or a revenue first, you'll typically figure out the whole journal entry. So give you guys one more minute and then we're gonna start run through these. So we'll start from the top. Over here. Number one, accrued or deferred? So for deferred, does cash come before or cash come after? Before. C before D. Cash before D. Accrual is when cash comes after. So A before C. So
What did you just say?
I'm gonna put it up here. So for deferred, C before D. Cash comes first. For accrual, A before C. Cash comes after. So we'll keep these up here for now. So for number one, is this accrual or deferred? Deferred. Now, is this an expense or a revenue?
Expense.
Expense, perfect. So what kind of expense are we working with here? Rent expense. So we know that's not gonna be our debit because expenses are always debited. What's gonna be our credit? For adjusting entries, do we use cash? Nope, we won't be using cash for any of these. Prepaid rent.
Why is that a credit then?
Because we're expensing it out. We're basically we paid for this in November and it's December now. So we're basically saying, all right, we're expiring it, we're making it go down because we use it up. Does that make sense? Awesome. So what's the values? How much do we expire this by? 2,000. Y'all understand how we got to 2,000? Yep. So we know we have, because it's November, we have 2 months of rent to expire. So divide this by 12, because 12,000 was for a year. So we need to figure out how much is a month. A month is worth 1,000. Then you times that by 2, because we have 2 months, which equals 2,000. Any questions? All right. So this one's tying back to chapter 8. So I thought I'd hit you with both of these chapters. So first things first, is this accrued or deferred? So are we going to be paying cash later for this at all? Deferred. The reason why, we bought the equipment first. We had to purchase that equipment with money, and after we purchased that equipment with money, then do we start depreciating it. So with that, what's going to be our journal entry? Do we do an expense or revenue? Expense. All right. So we know we have an expense. What expense are we using?
Depreciation expense.
All right. And what's going to be our credit? So first things first, how do we figure out how much depreciation we do? Straight line depreciation. Yep. Now it was easy on y'all. I didn't purchase this in the middle of the month. So how much is our depreciation? $2,600. 15,000 minus 2,000 equals 13,000 divided by 2 equals 2,600. All right, next one. On January 1st, we had $300 worth of supplies. We bought $1,000 throughout the year, and at year end, we had 400 left. Now, is this accrued or deferred? Deferred. Expense or revenue? So how are we going to figure out this one? C-chart. All right, first things first, where am I putting values?
Start with 300 for the debit.
All right. So when we buy more supplies, are we crediting it or are we debiting it?
Well, but, oh, okay.
Mhm. Reason why. All right. So what else?
Your ending balance of 400.
Perfect. Where do I go from here?
Figure out what money we need to credit in order to.
Perfect. And what value is that?
900.
900. So we now have our value. So what's our debit? What's our credit? Do you understand how we got here, y'all? Awesome. All right, we're gonna start moving this up and focusing on the last three. So we were paid in advance for 6 jobs worth 5,000. At year end, we finished 3 jobs. Now, is this accrued or deferred? So did cash come first or did cash come after? Revenue or expenses? All right. So now what accounts are we using?
And then revenue and service revenue.
Just like I said, whenever we start denoting if it's a revenue or expense, we already have one slot filled. Oh, what's happening here now? Take me away. Before we've been working with expenses, now we're working with our revenue. So instead of having a obvious debit, we have our obvious credit instead. So how are we going to figure out the value? Perfect. Yep. Should be 2,500. Another way to do it, we had 6 jobs, we did 3, we did half our jobs, divide that by 2. All right. We owe our employees $500 for services rendered, but they do not get paid until January 3rd. First things first, accrued or deferred?
Deferred.
Cash coming first or cash coming later?
Get paid later.
Yep, so that means accrued. Expenses or revenue? Expense. All right, so what's gonna be our journal entry for this? Wage expense. And what else? Wages payable. This one I didn't make you guys do any hard math. Just straight up 1 for 1. At year end, we have an outstanding note receivable worth $5,000 with 6% interest that was issued 3 months ago. Now, is this accrued or deferred? It's accrued. Because cash is coming later. We don't, with a note receivable, we're not expecting cash now. We're expecting it later. So is this a revenue or expense? Revenue. If this was a note payable, would that be a revenue or an expense? Perfect. So first things first, what's going to be my accounts? Yep, interest receivable. What's my credit? Interest, not payable, that revenue. Whenever we have a revenue, we always know our credit's going to be a revenue. So now, how are we going to figure out the value for this? How do you figure out how much interest the note receives?
It's 500%.
So we have 5,000 times that percent. Now, am I done? This is the annual percent, so we need to figure out how much interest we accrued. How much interest we accrued within 3 months? 3/12. Now, if I gave you guys a day value, let's say if I gave you guys 93, what would you do? 93 over 360, perfect. All right, but in this case, we're just doing this. Equals up to 75. All right. So the last two things is knowing about, well, first things first, is anyone confused on any of the financial statements? What's the first financial statement? Income statement. What's income statement? Revenue minus expenses. What's the second income? What's the second income statement? What's the second financial statement? Statement of retained earnings. What is the formula for statement of retained earnings?
Beginning balance plus net income minus.
Perfect. What's that equal?
Ending earnings.
Where did that go into? What's the third financial statement? Perfect. Do you guys know the difference between a classified balance sheet and a normal balance sheet? What is so a classified balance sheet?
Oh, is this the one we have to list out like the land assets and stuff?
So it won't look exactly like this on the test, but you'll know a classified balance sheet when it says, all right, current, long-term, plants, assets, fixed assets. It has many terms, but basically current and long-term. And then the same thing with liabilities. You have current or short-term, long-term. Equity, do we split that up between short-term and long-term? Nope. The only thing we have whenever we split it up is if we were to take a look at it and went to like the stockholders' equity. We have That's the only time we typically separate it between contributed capital and earned capital to the total stockholders' equity. Now, question, on a balance sheet, what will you not see? So we're just gonna be non-intangible assets. You would see intangible assets on a balance sheet. That's your patents, your trademarks, all that fun stuff. So you will see that on balance sheets. What will you not see? What happens because this is a third financial statement? What will you not see? You will always see retained earnings.
Is it after the?
It is after adjustments. This is after, huh? You wouldn't see income summary on it. You wouldn't see revenue or expenses. What else? There's one more. When you're looking at the balance sheet, you will not see revenue, expenses, dividends. This is, well, this is for any balance sheet. If you ever see balance sheet, this is the third financial statement, meaning this is after we've done our income statement. This is after we've done our statement of retained earnings, which means our retained earnings have been updated. It's essentially like if you had a bunch of Play-Doh in front of you. One Play-Doh is revenue, expense, one is dividends, and you took them all together, mushed them up, and made some brown colored retained earnings. So at the end of that, you just stick that back into your balance sheet, and that's where everything is. That's why when you guys are doing your practice set, if you notice at the post-closing trial balance and the balance sheet, you never had any of these accounts. That's because these are all in retained earnings. Now, I'm going to start throwing some accounts at you, and I'll see where you guys are going to start putting them. So, we're going to have cash. What kind of asset? Current. Account receivable.
Current
Current what?
asset,
Account payable.
current liability,
Note receivable.
Wait, accounts payable is short term?
Yep. Accounts payable is short term. You're thinking of note payable, which is easy to remember in chapter 4 when we're talking about terms of these accounts, terms of accounts payable and terms of account receivable. Each one were set into terms that were within a couple of months. None of them were ever for longer than a year. Typically, if you're ever going to do deal with debt for longer than a year, you're dealing with notes because those are much more formal and are signed sheets of paper. Bonds payable. We're not going to deal with equity because we have all of the equity accounts here. So make sure you do know that. So, equipment. Accumulated depreciation. So I haven't heard a correct answer yet. What was that? So it's not a current asset. It is a contra asset, but is it a current or long term? Long term. The reason why accumulated depreciation is the parasite account of equipment. You are right though. It is contra asset, so in the grand scheme of things, it lowers down our assets, and that's really good to know. What about allowance for doubtful accounts? What was that?
So it's been a minute.
Yep.
Is it all equity? Isn't it like a contract?
It's a contra asset. So where is it?
As, oh,
Long-term, this is for the year.
Now, question. Just like accumulated depreciation is a parasite account to equipment, what is allowance for doubtful accounts tied to?
oh,
debt
accounts
expense.
receivable.
Not bad debt expense, account receivable. If we remember back in chapter 7, we were introduced to bad debt expense, allowance for doubtful accounts, and accounts receivable. Now, we have something called net realizable value or the net receivables. How do we figure out our net receivables?
Does it come from your accounts receivable minus? Would it be minus your allowance for doubtful accounts?
Perfect. So it is your account receivable minus your allowance for doubtful accounts. Because of that, these two are very tied together. They're inseparable. So when you're thinking of where you need to put allowance for doubtful accounts, think of where you need to put account receivable. Same thing with accumulated depreciation. Accumulated depreciation cannot go without equipment. So now, building.
Or long-term asset.
Yep. Inventory.
Current asset.
Supplies.
Current asset.
Unearned revenue. Current liability, short-term liability. All right. I know I'm forgetting a lot, but I think we got a good understanding of where a lot of the things are. Is there any questions or is there any accounts you guys have been confused about and don't know where they go or why they go there?
Where would bad debt expense go? Or would it not be on?
So what is bad debt expense? It does decrease equity, but what do we not have on a balance sheet?
Revenues, it is.
In accounting, you will be noted what is an expense, what is a revenue, what is a dividend. They will tell you outright. Service revenue, consulting revenue, sales is sales revenue, but you understand, sales is sales.
Yeah.
Sales be sales.
Cost of goods sold, that would be.
So what is cost of goods sold? What type of account is that? So that one's another one that's a little tricky because that cost of goods sold is an expense account. So it would not be on here because that is tied up into our net income. It's tied up into retained earnings. Same thing with unearned revenue. Unearned revenue is not a revenue account. It is a liability account because of unearned, meaning we have not earned that, meaning someone can sue us. Any questions about a classified balance sheet or any accounts on here or any accounts you guys want to talk about that you guys want to see what should be on here? And we understand why common stock, preferred stock, PIK, and retained earnings and treasury stock are all in equity, correct?
Land does not depreciate, right?
Land does not depreciate, but where would it be on here?
Land long-term asset.
Yep. Very important. All right. The last thing is closing entries. Oh, actually, real quick. You guys just learned about it. Fourth financial statement. Statement of cash flows. So,
Sorry, can we talk about chapter 12 next?
yeah, of course. We'll finish this one up real quick with some closing entries. And real quick, is there anything else in the passage? Or you guys could have gone to chapter 12 next. Since... All right, chapter 12 next. All right, closing entries. Can someone run me through the process of closing entries?
Start off with
Debiting revenue. What are you debiting?
summary,
All right, what's next? All right, what's next? And just because I like putting this into perspective. Income statement. Basically, your closing entries, if you're ever confused, think about your financial statements. Because you're basically, like I said, putting your revenue and expenses into net income. So you debit your revenue into income summary, credit your expenses into income summary. That gets your net income. So that should be the same value as if you did the income statement that you then put into retained earnings. And then you take out dividends. And at the end, your retained earnings, if you took a P chart and went through every little step of this value here, your ending retained earning value on its C chart should be the same value as the statement of retained earnings. Something to see is looking at your project. Your project will show you exactly after doing your statement of retained earnings. It should be the exact same value as when you look at trial balance and your balance sheet of what your retained earnings should be. Or if you look at your general ledger. Any questions here? All right, let's start going into chapter 12. The first things first, what is the purpose of the statement of cash flow? Yep. Basically, we're going to look at our balance sheet and say, oh, yes, this is the star of the show. We want to figure out how did cash start off from A and go all the way to B. Kind of deal. So, what are the three categories of a statement of cash flow? All right, so with that in mind, where are we typically looking for each piece? So first off, operations. Where are we typically looking? Where on the balance sheet or the other financial statements do we usually pull from? Assets and liabilities, but what kind of assets and liabilities? Current, not long-term. So we pull from those current assets, current liabilities. 1 second, let me bring. There we go. So we got our current assets, current liabilities. There's one more place we have to look. What's the last place? Not equity. Well, close. Not gain and loss. Income statement. Basically, with the income statement, we're looking at net income, all of our revenue and all of our expenses and figuring out how they fit in with all of these. Investing. What's in investing? Long-term assets. And that's it. Financing. What do we have there? Equity. And what else? Not gain and loss. Gain and losses are found in income statements.
Dividends?
Not dividends, but good guess. Notes, what are notes?
Note.
Long-term liabilities.
Yes, long-term liability.
So, with each part of these, this is typically where we figure out the cash flows. Now, when we have non-asset accounts, are those important? Or not non-asset, non-cash accounts, is that important?
Yes and no.
Yes and no. So if I said depreciation expense, what are we gonna have to do with it for our cash flow statement? It'd go in the non-cash schedule, but what are you gonna do with it? So do we add it or subtract it? Add it. Oh, welcome in. So what we typically do too, and this is a little trick for y'all, something to keep in mind. With any of these, when we're dealing with cash, this is back to basics. I bet y'all love your transactional analyses. So every time we're doing this, we're always going to look at how this is relevant to cash. So if I said inventory, we had an increase in inventory. Does that increase our cash or decrease our cash? Decrease. So if we're thinking about any other asset, every time we have an increase in an asset, we decrease our cash. If we have a decrease in an asset, we increase our cash. Now, if we had liabilities, let's say account payable. If we have an increase of account payable, how is that going to affect our cash? So if we had an increase in account payable, how would that affect our cash? Increase. Same laws as the A equals L plus E. If we have an account payable and it increases, so does our cash. If we have an asset and it increases, our cash decreases. If it decreases, our cash increases. Sometimes I say if this doesn't work out, just know assets are opposites. Every time you see an asset increase, understand that cash decreases. Everything else plays by the rules and increases and decreases appropriately. Does that make sense? How can I make that sound better?
So is that why, like, when you're doing these, like, when your current assets go up, you subtract it instead of just adding it? Okay.
Yep, because if you think about it too, if we were to increase that asset, we had to decrease cash in some way. We're not going, obviously, when you get deeper into accounting, we get really into the nitty gritty. But for what you guys need to know to get through the class is just know assets are opposites. Assets are opposites.
On the cash flow.
Yep, on the cash flow, specifically the cash flow. And everything else just goes with the flow. You see a liability, you know it increases. You see an equity, you know it, wait, no. If you see a liability increase, you know your cash increases. If you see an equity increase, you know your cash increases. If you see them decrease, you know your cash decrease. Assets are the only ones that go opposite. With that in mind, I think there's some practice within the notes that I like to go through. Yep. So I'm going to throw some accounts at y'all, and you're going to tell me if they're operations, if they're investing, if they're financing, and if they increase cash or decrease cash. So first things first, depreciation expense. It is within operating, but like we said before, non-cash item. That's still important. Depreciation expense increases. What happens to cash? It goes up. Because you typically find depreciation expense in it or equity. So it increases. Purchase of land. So our land is increasing. Is that operating, investing, or financing? Investing. Increase or decrease of cash? Decrease. Sale of building. Investing. Increase or decrease? Increase. Gain on sale of building. Operating. Now, is that an increase or a decrease? So it's going to be a decrease. The reason why, with gains and losses, so this kind of breaks into my rule a little bit. Gains and losses are theoreticals. Whenever we have a gain, we're saying we have extra cash, but the thing is we already account for that. So we're basically double dipping. With gains and losses, they're considered double dipping. So what we need to do is we need to reverse it. So when you see a gain, subtract from cash. When you see a loss, add the cash. These are theoreticals to increase or decrease things on the net income statement or the income statement. It's a lot of wording, but just know gains and losses also are opposites. I think those are all. We'll add more to the list as we go through. Payment of cash dividends. Financing. You decrease cash because cash is going out. We found another already. Actually, no, because dividends, if you think about it, dividends in our equity decrease our equity. So I guess it goes same hand in hand with equity, but still breaks the rules a little, so we're keeping it up there. Exchange of land for stock. NC, non-cash. Cash does not exchange hands whatsoever, so we don't have to worry about it. So whenever we're dealing with any transactions and you see nobody touch cash, we just say, all right, have a good day. We don't need to worry about you. So that's only if we just said exchange of land, then we know we deal with cash, but exchange of land for stock, non-cash item. All right, increase in wages payable. Operation, increase or decrease? Increase. The sale of investment in stocks. Financing. So if we're selling investments in stocks, does that sound like we're getting money? If we're selling it, yes. It would be an increase because you're selling your stocks. So you get some cash back. The tricky thing is, investment in stocks, it sounds like stocks with our company. So that investment of stocks is typically our investment in another company. That's gonna be an asset. So that's not what I talked about in class. So that's why that one's a little bit more trickier. But investment in stock is an asset due to the fact that it's an investment in a different company. So when we're selling it, that's typically a decrease in the asset and typically a long-term asset. Decrease in accounts receivable. Operating, increase, perfect. Decrease in prepaid expenses. Operating, increase. Any questions on any of these so far? All right, I'll keep going. Let me know if any of these confuse y'all. Increase in accounts payable. Operations, increase. Loss on disposal of investment. Operations, increase. So the reason why, again, loss, we flip it because we'd be double dipping otherwise. So we give a loan to another company, basically giving them a note receivable. No, you're right, investment.
It is.
Because a note receivable typically is a long-term asset.
Increase.
So when we give someone else a loan,
Okay, yeah.
this is where, like, again, assets, opposites. Increase in account payable.
Operations.
So if our
increase, yeah, no, my bad.
increase. So interest payable is a liability, and since it's increasing, so is our cash. Decrease in taxes payable. Operations, decrease. Yeah, decrease in taxes payable. Increase in accrued liabilities. Operating increase. Awesome. Decrease in inventory. Increase. Sale of common stock for cash. Financing, increase. The reason why is because even though we have sale in that, if you think about it, sale of common stock for cash, typically we're issuing more common stock. Sale of common stock is just another fancy term for issuing common stock. Purchase of debt instrument. So debt instrument is typically a bond payable. Financing.
Purchasing decrease.
So that's where it's kind of tricky with purchasing a debt instrument. Actually, I'm going to skip that one actually, because that one's a little trickier and I don't think that one's specifically going to be on the test because purchase of debt instrument. A debt instrument, typically if you're buying someone else's bond payable, that's going to be a bond receivable for you. And that's just another can of worms for long-term asset and investment. But if you're giving someone, like you're issuing a bond payable to someone else, that's a liability, a long-term liability, which is a financing increase. If it's investing, if this was an investing activity for a bond revenue, not bond revenue, bond receivable, that would be a decrease. So that one's just tricky. So we're not going to go too deep into that one. Actually, now seeing the one below it, issuance of bonds payable for cash, financing increase. So that's purchase of debt instrument, investing decrease. I should have read ahead. Purchase of treasury stock. What was that? Decrease. The reason why when we buy treasury stock, we pay it in cash. Sell of treasury stock. Purchase of delivery truck by signing a note payable. On cash. Purchase of a delivery truck by signing a note payable. There's no cash that's been exchanged yet until we pay that note payable.
Okay.
Amortization expense. Operating increase. Basically, amortization, there's been no cash handed, but we're decreasing. So the reason why these expenses are important with amortization and depreciation, despite the fact that we do not have any cash exchanging hands when we're expensing these, we have to basically reverse them to say, because you're lowering your net income, you're lowering your cash amount because you say, all right, we expense that, but no cash is exchanged hands. Because no cash is exchanged hands, we need to basically reverse it. And that's why we add cash back in for these expenses, because we're saying, all right, we expense that to lower our cash, but technically we never had cash to begin with. So we have to put back our cash in. Does that make sense, y'all? Okay. Anything else on chapter 12? Are y'all good? All right. What other chapters do you guys want to go over? Or any concepts or anything that's been confusing this semester? We got an hour and 30 minutes still, so we're still in good time. Yeah. Chapter 7? Yeah. We all love chapter 7 here, right? Favorite chapter? What was chapter 7?
Is that the ADA account?
Yep.
Oh, yeah.
We all love chapter 7. I say that with the most sarcasm. I've yet to see, chapter 7 is one of the ones that I get to see someone actually like. All right, have a good one. All right, first things first, everyone remembers the expense recognition principle, right?
Yes.
What's the expense recognition principle?
Incurred.
Yep, recognize expenses when they are incurred. Yes, this is why we have the whole ADA allowance method. So I want to remind everyone of these 3 journal entries, right? These 3 accounts in this specific order. So We have bad debt expense, allowance for doubtful accounts, and accounts receivable. I put them in this way specifically because if you ever had to do the journal entry, this is the order you would have it in. Right over here is your adjusting entry. Right over here is your write-off. Basically, you cover up one of these to figure out which accounts you're using, because due to this being the allowance method, bad debt expense will never touch account receivable. You'll always have allowance for doubtful accounts as a buffer. Now, allowance for doubtful accounts, what kind of account is that? Contra asset, decrease in our assets. What kind of balance does it normally hold? Credit. Bad debt expense, equity. What kind of equity account? A debit. So it's expense, it debits, decreasing our equity. Now, with the going back to chapter 7, we had to figure out how to how much would be in our allowance account. Does anyone remember how we figure out what number is in our allowance account?
Isn't it determined by the company?
Not cost of goods sold. It is determined by the company. So it is the percentage of account receivable. That's the method you guys learned, percentage of account receivable. How that is done is by taking your account receivable, you multiply that by a percentage, arbitrary percentage you'll never have to figure out. It'll always be given to you. And it's an estimate. This is an estimate to figure out. This is why there's not really a lot of background for it. These are really just estimates to kind of put away this expense for a piggy bank to say, hey, in this year, in this current year, you got year 1, year 2, year 3. In this year where we got this account receivable, we don't expect to get all of it. So we're going to expense out within the year that we accrued this. That way we're following GAAP rules. As well as that, it makes sure that our net income is not affected. We know how much we are expensing for that year for our account receivable, so it will not be affected by direct write-offs. So I'm gonna put a practice problem to keep all that up there. I'll let you guys run through it, see what you guys can do on your own, and we're gonna walk through it together. I'll give you guys about 4 minutes, 4 or 5 minutes. I don't like the wording I put for this 1 second. Information's all right. This is not going to change anything besides just the wording. All right, part 1's out. I'm going to start putting 2 other parts to this. All right. Got 3 things over here. The company has a total account receivable balance of 60,000 and a debit to our allowance account of 400. At year end, we estimated we will not collect 8% of account receivables. That's gonna be part 1. Part 2, Jay cannot pay his account of $300. He owes us, he owes us. Make journal entries for the allowance method and the direct write-off method. So you're gonna have 2 journal entries for the same thing because we're trying to figure out the difference between the allowance method and the direct write-off method for the situation. Last, Jay has paid us back in full after we wrote him off. This means that what you need to do is figure out how to reinstate his account and then take the cash. I'll give you guys 5 minutes to work through this, and then we're gonna go step by step through this.
So are we writing him off?
We are writing them off. You're gonna do it in both the direct write-off method and the allowance method. So 2 journal entries, same thing. Yeah. All right. While everyone's working on that, I'll take a look at yours.
Doing the general ledger right now,
Mhm.
and like, you know how whenever you put it over here, it goes
Oh.
over there?
Here, I'll be able to fix that. For some reason, it wasn't coded all the way. And all you need to do for any of these is Control C, go down, Control V. There you go. And then you just do the same thing, but make sure you're picking it up from the same column. So don't just pull it from here and then try to pull it down here. What you do for, like, example, the cash kind of has it all together. But like,
I'm starting with it with this.
so yeah, if you have other accounts that are like where it's not updating, just Control C, bring it down.
Okay, thank you.
Yeah, of course.
Second one.
The second one, Jay cannot pay his account of 300. He owes us. Make journal entries for the allowance method and the allowance and direct method. Sorry. Yeah. Sorry, this board is awful to write on at times. Give y'all about 2 more minutes. All right. So first things first. Let's walk step by step through this. What do we got to do to find the value we need?
Your total account receivables and multiply by the percent.
So we take our total account receivable, multiply it by the percent. What value did you get?
4,800.
So 6 times 8 equals 48, and you take 2 decimal, you take 2 zeros off for the decimal points, so 4,800. Now, is that always stop to make the journal entry? So what else are we doing? How do we do this? That 400. So we're gonna make our ADA here. We love T-charts here, we love them. 400 in the debit side. Where do we put this? Where do we put this 4,800? Now, is that on the debit or the credit?
Oh,
Credit. ADA is one of those accounts, it has a normal credit balance, but there is chances where in the previous year, our estimation was off and we took away more than we had accounted for. So that leaves us with a debit. So we don't put it as a normal debit balance, you always put it over on the credit side. And if you ever see that ADA has a debit balance, sometimes it does, and that just means one thing. What's gonna be the value we're using?
like, are you asking?
Yep.
4,200.
So where do you get 4,200?
What you just subtract?
When they're on opposite sides, so
Oh, do you add it?
you add it. The reason why is because right here, we have to first make this account 0. So we'll take 400 here to get 0. Then we have to get from 0 to 4,800. So that's why we just typically just add them together, because we get 5,200. And that's gonna be our value. Now, what's our journal entry? What are we debiting? What are we crediting?
Allowance for that one account.
We do credit allowance for doubtful accounts. For 5,200. 200. What are we debiting? Accounts receivable. Wait, nope, we're not debiting that. Sorry. Nope. We wouldn't debit accounts receivable. The reason why is because we're not adding more account receivable to the balance. We're not buffing up our account receivable. In fact, with this, we're not, the reason why we have our allowance method here is so that we have that buffer, so we don't touch account receivable at this moment. What's gonna be your debit? Bad debt expense. Have a good one. We are expensing in the period that we expense in. So this right here is specifically the reason behind this, where we're expensing in this period that we think we need to expense in. We think that accounts here will write off or won't be able to pay us at this point in time. So we're expensing in the now. That's why this is our adjusting entry. And why I set this up in this fashion, because if you notice here, this portion is exactly that entry. Now, any questions here? Making sense? Don't worry. I never understood this chapter till I tutored it. It's a tough chapter. There's probably not going to be a lot of questions on the test about it, but if you can take the little tips and tricks that I'm showing y'all and at least understand the method enough that you can kind of fake it till you make it kind of deal, you'll get by. So memorize the accounts in this order and know that the first two accounts are typically going to be your adjusting entry. We cover up account receivable because we don't use account receivable in this period when we're trying to figure out how much is in our allowance account. And to get the balance of our allowance account, you take your account receivable, multiply it by the percentage, and put that at the ending total, and then figure out from the start to the end what value you need. So we're now going to go over to the write-off. We have two different journal entries. We're first going to talk about the allowance method one. We're going to keep going with this while we're rolling. So what's going to be our debit? What's going to be our credit?
Accounts payable, credit AR, and debit data.
Yep. Credit AR, debit ADA. The reason why we're not doing payable here is because we don't owe anyone here right now. We have nothing we're saying we owe someone. This is with someone else, one of our customers who says, hey, I can't pay you, sorry, do it. So we write off his account. Just to kind of keep track of what we're doing here. Nope, that's not the end balance. Not needed to, this doesn't need to be known, but it's just, I like the visual. If it helps you guys understand the process of what's happening here, all the better. So ADA 300, AR 300, debit and credit. Now for the direct write-off method. What's our debit? What's our credit? Let's do our credit first. No matter what are we decreasing? Yep. No matter what, our account receivable is decreasing by 300. We're saying this guy cannot pay his account, so we just write it off the books. Now the difference is the debit. Now the debit for the direct write-off method, are we still using our allowance ADA account? Nope, we don't have that buffer. What instead do we use? Because there's no buffer. Not cash, we're not bad debt expense. The reason why not cash is he's not paying us. We would only debit cash if he's giving us money. Now with that, we have Jay has paid us back in full after we wrote him off, meaning that he has reinstated his account. How do we reinstate the account?
Just flip the previous.
Flip them.
You're all gonna be in here for.
So they told me I had the room till 4 today. Did they make a mistake? And if so, should I go see what's happening? Because I think since Maddie no longer had control of the classrooms, things have started to get messed up.
That's okay, I should be able to do mine out here.
If need be, let me ask, huh? Are you sure? Okay. So Jay has paid us back in full. So what's gonna be our accounts?
You would,
I think account receivable and cash.
We would have account receivable and cash, but we have to do something first. What were you saying?
I was gonna say you credit allowance for doubtful accounts.
And what are you debiting?
For cash.
You account receivable.
Account receivable.
And then we go to cash.
Okay.
The biggest reason why is because we first have to reinstate his account. We have to say, all right, you do have an account with us. Don't worry, we haven't forgot you. We have to flip over this previous journal entry. And then we're able to say, all right, now you can pay us off. And that's when we finally say account cash and account receivable. That's chapter 7 in a nutshell. The only other thing would be note receivable, but we went over a note receivable example before, and I'm going to bring that back over. Look at how much stuff we did today, guys. So we had the 5,000 times 6% times 3/12 equals 75. To find your interest for note receivable, just know your principal times percent times how long you have it. If it's over a year, you only do a year of interest. If you only have it for a couple months, you have to figure out how many months of interest you accumulate.
We use 360 instead of 365.
Yep, banker years. All right, what other chapter do we want to go over? Or is there any other questions for chapter 7? No? Understandable. Chapter 7 is the big one. As well, too, if you guys think and realize you need help on another chapter after this group session, feel free to go back into the YouTube. Every chapter besides chapter 12, and after I put this up, chapter 12 will technically be on there now, is up there. You're able to find the specific chapters or the exam review sessions we've done in the past, which are really great because we just rapid fire through the notes from part A to Z.
Thank you.
Have a good one.
Thanks for help.
Yeah, of course. All right, what other chapters do you guys have in mind?
Do you remember what chapters were on the first phase?
Chapter 1, 2, and 7.
Sorry, do you remember the ones on the second test?
Chapters 4, 5, and 8.
Can we
Have
do
you?
chapter 8?
Yeah, we can do chapter 8. So a lot of the things, we went over depreciation. So what's depreciation? What is depreciation as a concept? First, before we talk about the journal entry.
Like, how much the value of an asset increases?
Perfect. Basically, that thing always trips me. How much an asset decreases in value over time. So the biggest reason why we have that is because we want to be able to figure out an asset's book value. Now, with depreciation, when we're losing assets value over time, are we typically taking that value out of the asset itself? Nope. Due to the historical cost principle, our asset for however much we buy it is specifically at that value. So you'll have your equipment at a value. You'll then have your accumulated depreciation at a value, which you subtract from your equipment to get the book value. So with that in mind, how do we figure out depreciation?
Cost minus the salvage value divided by the useful life.
Yep. Now, if that useful life started in the middle of the year, what else do I have to do to this?
Multiply by 6 over 12.
Not 6/12, but you have the right idea, n over 12. So n being whatever months, how many months you need. So if we got an equipment on April 1st, what would n be? Not 8,
7,
9.
9.
Because you count the whole month of April. I won't let myself live that down. So you count the whole month of April from April 1st. So you count all of April, May, June, July, August, September, October, November, December, 9. Same thing if, let's say, we'll go to like May 31st. Do we count May in that? Nope.
Wait, what was it?
31st, May 31st.
What we counted in?
We would not count May.
No, I'm saying what we counted.
To figure out n.
Oh, okay, I see.
Yeah. So instead we do June, July, August, September, October, November, December, 7 months. So knowing how to do that to figure out how much depreciation we have is very important. Now, what's the difference between depreciation expense and accumulated depreciation? So depreciation expense itself is our expense value. So that is only yearly. We take it out a year and it resets the next year. It does not stick around with us. Accumulated depreciation, on the other hand, stays with us. It basically sticks. We'll have basically accumulated depreciation. We'll just put AD. We'll typically keep adding to this. So we'll rather run out of depreciation to expense, or we sell the asset. So if we had 4 years and we accumulated 1,000 depreciation each year, after the 4th year, how much would our accumulated depreciation be? So we have each year we're taking out $1,000 of value in depreciation. How much depreciation will we have by year 4? 4,000. Just keep going. Add it all together, and that's your depreciation. Now, if we had a truck, we'll say it was 6,000. Its book value would then be 2,000.
That's after 4 years.
That's after 4 years. So each year, the book value itself is changing. The equipment itself stays the same value. It won't change. But that accumulated depreciation, due to the fact it keeps increasing, goes to 2,000. Now, let's say we're going to sell this truck. We're going to keep these values. It was worth 6,000. Cumulative depreciation was 4,000. We sold this truck for 7,000. Actually, no, I don't like that number. We're gonna sell this for 3,000. Or as well, sold it for 1,000. Make 2 journal entries for each scenario involving these numbers. I'll give you guys 3 minutes for this.
I have a question.
Yeah.
So for the beginning balances, I don't do anything with these, right? This is just there. to
Yeah,
use?
that's just there to use.
Okay. I think I changed it. Sorry, I swear I tried to.
No, you're good. You're good.
But I think I changed some of the numbers because I didn't know.
Let me check real quick. I'll be able to fix it.
Okay.
So let me see.
3850. I
No,
think the
they're all
cash
good.
is the cash, right?
Yeah, all of them are right.
Okay. Thank you.
All right. Let's start running through the first scenario. So we sold this for $3,000. First things first, what's going to be our debits? Cash. How much?
3,000.
3,000. What else?
Cumulative depreciation,
Cumulative depreciation. For how much?
4,000.
Perfect. Now, what are we gonna be doing with our equipment, debit or credit?
credit.
All right, is this the end of our journal entry?
No.
Nope. What else do we gotta do?
Record a gain,
Record a gain. Gains are credited. How much is our gain?
1,000.
Any questions here? No, awesome. So now we sold it for $1,000. What's gonna be our debits? Accumulated depreciation, a loss. And what else? Cash. Ignoring the loss right now. As you see, there's a formula to this to figure out, all right, what's happening. You'll never not debit your cash. You'll never not debit your accumulated depreciation. And you're always going to also credit your equipment. So how much was our loss?
1,000.
1,000. In each cases, the status quo is always these three accounts. Whenever you're dealing with selling assets, just make sure you understand the process and you'll be able to fill in the blank with a loss or a gain. Remember, loss left, gains are like revenues, so you credit them. Losses are like expenses, so that's where we debit. All right. And then besides that, you guys know what intangible assets are, right?
Yes.
What's an intangible asset?
It's not physical, right?
Not physical. Any examples?
A trademark.
Trademark? Anyone got any others?
Prepaid rent.
Prepaid rent is tangible in a way.
Um,
We're talking more like intellectual property. So
a patent.
patent, so trademark, patents, things like that nature. I can see where prepaid rent can also think like an intangible asset, but that's typically like, I don't know. It's hard to say because that's more just staking claim to being able to stay in this room for a long period of time. And the room itself is tangible. We pay the rent for it. And then, so yeah, trademarks, patents, things of that nature. What about goodwill?
Oh,
Yep.
yeah, that's intangible.
And do you guys know what goodwill is? Basically, it's typically used when people buy companies for more than they're worth. The reason why is because of this intangible asset of rather they have really good clients that they have really good relationships with, or they had really good staff that you can't just replace. So they pay at a premium amount, and that excess over what it's worth is goodwill. Now, what about if I said amortization expense? Do you guys know what amortization expense is? No? Amortization expense is a depreciation expense for these intangible assets. So amortization is for intangibles. What about depletion? Depletion expense. What do y'all think about that?
That's just for,
Question, do we depreciate land?
oh, no.
Nope.
It's for something.
You're close. Natural resources. Oil, gas, anything of that nature is depleted because typically you're pulling it from land. So that I can understand where like the lines cross there. But no, the difference between depletion, depreciation, and amortization. But that's kind of just a run through of chapter 8. We can run through a problem as well to figure out how to depreciate. Or do you guys want to move on to another chapter? We got about 30 minutes left.
And she said she's gonna ask about depreciation being able to calculate the straight line. What is that?
So straight line calculation is this right here, where we have cost minus salvage equals divided by useful life.
Okay.
So let's run through a problem real quick. All right, we bought a truck for $8,000. Its salvage is believed to be $1,000, and we believe it has a useful life of 5 years. Figure out the depreciation and figure out the journal entry for depreciating. Give you guys like 2-3 minutes on this one. All right, let's start going through this. So what am I doing first? Yep,
Divided by the useful.
8,000 minus 1,000 divided by 5,000. What do we get from that? 1,400. Now, what's going to be our journal entry?
Depreciation expense, 1,400, and cumulative depreciation, 14.
Here's your journal entry. All right. We got 30 more minutes. Any specific chapter you all want to focus on? Start going down the line. Y'all feeling good about chapter 1? Chapter 2.
Wait, what is chapter 8 about? I can't remember.
So chapter 1 and 2 were about debits, credits, financial statements, and about the accounts. So knowing your assets or liabilities or equity, knowing which one's debit, which one's credit, knowing how to make a journal entry. So we're feeling good about those. We went over chapter 7. What about chapter 4?
Can we gloss over that real quick?
Yeah, definitely. So chapter 4 was when we were talking about how we bought, doing a lot of journal entries on buying and selling inventory. So that's where we were learning about the terms and all that fun stuff. So first things first, do we know what 3 over 10 is?
Like as a decimal.
Not as a decimal, but as a term.
Oh, that's the percent, right? 3%
3%. And what's a 10 mean?
if they paid into names.
Yep. So let's work through a quick problem. This will have 4 steps. Now, quick question, do we want to be the buyer or the seller? Seller? All right, we'll be the seller for this one. This one's good because the seller has a lot more journal entries. Keep that in mind. A, better practice. We do the hard ones here because that way when we go over to the test, be able to figure it all out.
That's the end of the entries. It's free.
That had a cost. Yeah. No problem. All right. A lot of shorthanding, since we only have 30 minutes, I really want to rush through this because I want us to do the seller side and then I want us to do the buyer side. So we sold $4,000 of inventory that had a cost of $2,000 on terms of FOB destination 2/15 and over 30. Shipping was $100 in cash. The customer returned $1,000 of inventory that had a cost of $500. The customer paid in full. If there's any questions, let me know. I'm gonna give you guys about 5 minutes. Hello.
Hi.
Welcome in. We're working on chapter 4. Don't you miss being the seller and the buyer though?
I don't even remember that. I'm gonna be honest.
Eh. It'll all come back, rushing back to you.
Yes. This like the accounts receivable stuff.
Yes. So right now we're the seller.
Okay.
So we sold $4,000 of inventory that had a cost of $2,000 on terms of FOB destination 2/15 and over 30. Shipping was $100 of cash. The customer returned $1,000 of inventory that had a cost of $500. The customer paid in full. We also have dates nicely put to the side, meaning they are important.
Okay.
It attacked me.
I have a question.
Yeah, of course.
So I'm on step 5 right now.
Do I just use if there's no, because I'm doing the adjusted trial balance?
And you finish up step 4?
Mhm.
Okay.
So I know I use these, like the normal balance, I guess, for the adjusted entry. Do I use the ones from the unadjusted as well? Like if there was no changes, right?
If there's no changes, you use the ending value in the general ledger. So make sure you're getting all of your values from the general ledger, as annoying as it may be. I'm just checking over the numbers real quick. Yeah, you're all good. Yeah.
So we're the company, right?
We are the company. Oh, I just realized the top thing's been covering the top thing this whole time. Give you all around 2 more minutes. All right, let's start running through this. So, first things first. Sorry. We are the seller in this problem. What's going to be the case because we're the seller? Do we have one journal entry or two? Two. I like to call it the profit and the product. So the profit portion first. What's the profit portion of our journal entry? What's our debit? What's our credit?
Cash.
So the revenue part is right, the cash part is wrong.
Accounts receivable.
Yep. The reason why we use account receivable is because we have terms. The moment you hear terms,
Yeah, right.
you know we haven't paid. So that's going to be called the profit portion because we're dealing with the profit. Now, what's the product portion?
Inventory credit to them.
Credit to inventory. For how much?
2,000.
2,000. What are we debiting?
Wait, like,
Cost of goods sold.
oh yeah, right, I forgot this account.
So if you notice, the reason why we split between profit and product is because there are two different values here that we need to take into account. We can't just shove inventory in with our accounts receivable because technically the profit portion, we have made $4,000. They owe us $4,000. We can handshake on that and say, have it at the end of the day. We know that the expense of our inventory was 2,000 and inventory we're losing is 2,000. So that's why we separate it out. Shipping was $100 of cash. Who was in charge of shipping, us or them? Us. Why is that?
It's destination we gotta bring it.
Destination means we have to bring it to the customer. So we're in charge of destination. What's going to be the journal entry?
Shipping expense.
Yeah, shipping expense. What's our credit?
Cash.
Cash. All right, the customer returned $1,000 of inventory that had a cost of $500. Again, profit versus product. Two journal entries. What's our first journal entry for profit?
Revenue.
Not revenue. What kind of special account do we use when people return objects?
Something return allowance. Oh, it's sales returns and allowances. Couldn't figure out the first word was.
What's our credit? Account receivable. We lower the account balance because technically if I go to Walmart with products that I want to return, I don't want them to stare at me. I want them to say, all right, have a good day. Your debt has decreased, or here's some cash. And the reason why companies separate their revenue from sales and returns is typically so when we're doing our net income statement, when we're seeing how much our gross profit is, we want to see if our sales was lower than expected. We're able to see how much we've given in returns. Same with discounts. All right. What's the other journal entry?
Inventory and cost of goods sold.
Inventory and cost of goods sold. This one's not as complicated because all we have to do is swap them out. We did not sell this inventory and we did not sell this cost of goods sold. Any questions so far? Awesome. All right, the customer paid in full. So is this a discount or is this in full?
But it's
Discount. How do you know?
paid on the 10th.
Paid on the 10th. Their terms was 2/15. And they paid us in 9 days. So with that in mind, the customer paid in full. What's going to be our accounts we're using? We're using cash, we're using discount, and accounts receivable. What's going to be debited? What's going to be credited? Debit to cash. What's our discount? Debit or credit?
It's
debit. The reason why is because this is going to eat into our cash. This is going to lower our cash value. We credit our accounts receivable in full. Now, do we credit account receivable for 4,000 or did something happen?
Something happened.
Something happened. We have to take our 4,000 minus 1,000 to get 3,000. Now, how are we gonna figure out our discount?
2% of 3,000.
2% of 3,000. They got a nice discount of $60. And that's gonna be our journal entry. Any questions? All right, now we're gonna flip the script. We're using the same exact information, but now we're the buyer. I'm not gonna refigure the problem too much, but do journal entries as a buyer of this, where we're focusing on, all right, we bought $4,000 worth of inventory. We will ignore 2,000 on these terms. Everything else is the same, except we're not worried about how much the inventory had cost for the other people. We don't know how much the inventory costs for the other people. It'd be interesting if we went to Walmart and bought like a roll of paper towels and they said, hey, yeah, we bought this whole stack for like $2, but we're gonna sell it to you for $6. I'm gonna give you guys 5 minutes to rewrite this through the buyer side. And a little trick, the whole cycle revolves around inventory. Feel that on my soul.
I completely forgot. I feel so bad. I had an economics tutorial appointment at 3:30. What happens if you're no-show? Is that bad?
They just mark it. And if you're too many, like, if you're too many no-shows, we'll just cancel all your future appointments. Not like currently like we had a case where someone booked an hour with accounting people, and I mean multiple accounting people. So I think like 3 accounting people had at least 1 hour a week with this one person. All of
They
us. So
kept canceling?
they kept not showing.
Oh,
Apparently they changed major, like they dropped the class and they never told anyone or canceled all their future appointments.
dang. I would be mad.
So if you
I
Go-
think this, or sorry, what?
Hmm?
What were you saying, sorry?
typically like any other tutor is able to see like a no-show, and it doesn't matter too much if it's like once in a while, but like if we see it happening a lot,
Yeah.
then we're able to probably reach out, see, hey, what's happening.
I feel so bad. Can you see how many no-shows I have? Does it show you, like, unless I don't make an appointment with you? Does that make sense? Because I think I haven't done it much, but I feel so bad. I forgot.
It's okay. Nick will learn. No. So if I,
It shows me my GPA. Bro.
we don't really look at it much. A lot of people just kind of run through reports, and not even many people even do that.
Yeah. And
But-
it shows you my picture. Oh my goodness.
But yeah, with that, we're able to see other reports that people make, just because that way we're able to say, a lot of people are able to see what works well for you. So like we'll typically make reports after appointments to say, hey, this person really did well when we did this and this and this. And that way people can go back and say, hey, I see you worked really well with this. But that's if people actually go through it. Most people just see the appointment go through, so you don't have to worry too much.
Yeah, that makes sense. Excuse me, sorry.
So anyway,
Finished step 5. Is there any way, I'm pretty sure I did it right because they're balanced.
let me
but-
double check.
Okay, thank you. Because I don't know, like I said, my vision is pretty bad, but like I kept mixing up the numbers with the accounts that it belongs to, so.
No, everything looks perfect.
Yay, I'm finally making progress.
So you're at basically the crux point. I believe you can finish this up in an hour.
Yay.
Okay.
Okay, thank you.
For the income statement and statement of retained earnings, just pull from the adjusted trial balance. Don't worry about the general ledger. Worry about the general ledger when you get to your post-closing.
Okay.
They'll hopefully make it easier for you too.
Is that where, so that's where I still reference from?
Yeah, so I'll reference from your adjusted trial balance when you're going through your income statement, like your income statement, the statement of retained earnings and the balance sheet.
Mhm.
And then you cell reference back to the general ledger for the post-closing after you do your closing entries and update your ledger. All right, I'm gonna give you guys like 2 more minutes on this.
Shipping point or still the destination?
Still destination. Good question though. All right, let's start going through this. So as the buyer, and I'm gonna make this in green, so we know, hey, buyer. We don't have to worry about multiple journal entries for a lot of things because we're just worried about the value of inventory. So a little trick, if you ever see you're the buyer on the test and you need a journal entry for this, one of the journal entries will always be inventory. So first scenario, we bought $4,000 of inventory on terms of FOB destination, over 15 and over 30. What's gonna be our journal entry for buying? Inventory 4,000. What's gonna be our credit? Accounts payable. All right, shipping was $100 in cash.
I think we credit inventory.
Typically do, but in this case, we're FOB destination, so we don't worry about it. Because
Oh, yeah.
if it was shipping point, you worry about it. Now, if we were to do journal entry for it, it would be a credit to inventory. Wait, no, it would be a debit to inventory.
Could be worth more.
Yep. For $100 and a credit to cash for 100.
I get that.
But that's on FOB shipping point. All right. Number 3, the customer returned $1,000 of inventory. So we returned $1,000 of inventory. What do we do?
Accounts payable. 1,000.
Accounts payable is debited by 1,000.
Then credit inventory for 1,000.
Yep. Last thing, customer paid in full. Again, we are paying within the discount period. What's gonna be our journal entry?
Accounts payable 3,000. Thanks. Cash 2,940 credit, and then just sales discount 60.
Nope,
Dang it.
that's the tricky part here. What's our discount account? Inventory,
Yeah.
because this whole cycle revolves around inventory. And our inventory loses value due to the fact we purchase it for less. Yeah. Any questions on this?